with that, I'm going to bring David up. Dave Weild, ladies and gentlemen, Chairman of Issuworks and former Vice-Chairman of NASDAQ. And one of the reasons why I even got involved in this was really reading and becoming inspired by a lot of David's work. So really excited to see his presentation.
Thanks, Dara. See if is this thing on or?
Yeah.
Is it on? You can hear me okay. Well, first of all, there's a lot of people here I know are friends who've done a hell of a job down in Washington, and I want each of you. I want to thank you. I went down with Kim down to see the Black Caucus. I'm smart enough to know that you're going to find that I'm a pretty plain talker. And one of the things that really has disturbed me is the lack of capital formation activity in the United States. And this goes back to 2007 when I first started going down to Congress to sort of light the fire that ultimately created the Jobs Act. One of the things that I took from the Pew Institute, which was the average African American in this country has $5,000 in liquid assets. Okay, that's nothing. Okay, and so when you look at and this is one of the we'll talk about tick sizes and the need for aftermarket incentive to support liquidity and capital formation. But my point to members of the Black Caucus, we went in to talk to Maxine Waters' staff, and she's in the House, the minority leader in the House Financial Services. We went to see Congressman Scott from Atlanta, who's a graduate of Wharton, and what we said was, look, we're putting a lot of people who are of lower means out of work. We're depriving them of jobs. Okay, that if you can put more money to work, there's a multiplier effect. Professor Enrico Moretti at the University of California at Berkeley says that there's 5 service sector jobs created for every technology job. Okay? So if you are an African American and you are the norm under the Pew Institute, you are not deriving any benefit from low-cost trading in this country because you don't have enough money to day trade stocks. Okay? If anything, you've got money in a mutual fund in this country, okay? And mutual funds have been hurt by the loss of liquidity in small cap stocks because of lack of market making. And so if you go and you look at the tick size bill that was ultimately, and I testified in favor of this, it was actually an idea I floated a number of years ago to a different congressman that then picked up steam. It passed the House Financial Services Committee 55-zip, okay? Bipartisan, to their credit. It passed the House 412-4, okay? So we didn't get a Senate companion bill out, and now we've got the tick size pilot at the SEC that sort of we're waiting for that to come out. This will happen, just like Reg A Plus is going to happen, okay? It just takes a long time. You can't get frustrated. You can't turn your back on this. As these panelists said, and I will point out, if you look at the repeal of the prohibition against general solicitation, a paper that we wrote, which was a look at page 30 of A Wake-Up Call for America. That's where that came from, okay? And that's creating, if you will, crowdfunding to accredited investors, if you will. It allows you to generally solicit, and this is going to create a sea change in the way. A companion to that, if you will, is if you look at Title I of the Jobs Act, the IPO on-ramp is the so-called testing the waters provision, because it used to be in the public markets, as you were ramping up and marketing to go public, that we had to shut down marketing six months before we filed an IPO. Now today we don't have to start that. We don't have to stop that marketing process all the way through to qualified institutional buyers. And the beauty of that, and I'm going to show you some data a little bit as we get into this, is that it's actually helped us broaden the market for biotechnology stocks. And so as a consequence, biotechnology issuance has been up. Okay, why? Back to what this panel said is you got to tell the story. Somebody's got to get on the phone. Somebody's got to meet with people. They have to internalize the story. And that's why, with all the data in the world, and we're big data miners, at Issuworks, on the institutional front, you still need somebody ultimately to get on the phone to close the deal, whether it's a research analyst, it's an investment bank, or somebody, there's a salesman. So let me run you through. And so what we do, and we're sort of the opposite end of what everybody else here is doing. We use data mining, deal science, but we focus on the institutional marketplace because we believe that one of the problems is that there are 60 institutional investors today that now generate 90% of the commissions to Wall Street. There's another 3,000 out there. There's some index funds you got to strip out of that number. They just don't get reached, okay? And so what we do is we use a totally different marketing system with sales to effectively figure out what the right subset of those institutional investors are, because we don't want to spam them and we want to get out to them individually. We think we can double demand on just about any equity offering under $2 billion in market value, and we have so far. And it's better quality demand, because most of the people that aren't getting contacted in the long tail of the distribution curve, institutional, they don't play the calendar, so they don't flip stocks. And when you're calling them, they're pre-qualified. You know what their turnover rates are. You know what their behavioral patterns. They're good buyers, okay? Think about it. If you're a smaller investor, two ways to solve a liquidity problem, right? One is to fix the capital market structure. There's more incentive for market makers. And the other one is to reach smaller investors systematically who don't have a liquidity constraint. But that's tough because there's no money in the business. So you have to use technology to effectively drive down that curve. So the title it was of the conference is Enhancing Aftermarket, or this part is Enhancing Aftermarket Support and Fostering a Robust Secondary Market for Reg A Offerings. I will tell you that there's not going to be anything significantly different between a Reg A offering and a public offering, okay? They're stocks, and they need to be, there may be some regulatory morass that you have to run through, but at the end of the day, a stock is a stock. I don't care if it's a private market or a public market, there has to be adequate incentive for market makers and salesmen to get on the phone and move the merchandise. So I'm going to just quickly give you a little way that academics and look at markets. And if you read the academic literature globally about stock market structure, you're going to find that large cap stocks are what they call symmetrical order book stocks. They enjoy the network effect. Thousands of investors at any point in time looking at Intel trading, okay? It will not slip through the cracks. And Exxon Mobil, same thing. Anything in the S&P 500, the CAC 40 in France, the DAX in Germany, the FTSE 100. These are innately liquid stocks, but that's not the normal condition for small cap stocks. These are what academics call asymmetrical order book stocks. Big buyer, no seller. Big seller, no buyer. And if you don't have an economic model for somebody to create liquidity and find the other side of the order, these stocks break down, which is exactly what's been happening. These are the innately illiquid stocks. And I don't understand why the SEC seems to have such an issue trying to, or at least some of the members of the staff, they're starting to get it. If you read the academic literature, it's plain to see. Smaller tick sizes, which is the smallest increment that you can trade a stock in, right? If you decrease the tick size, which today is a penny, it improves liquidity in already naturally liquid stocks. If you decrease the tick size in innately illiquid stocks, it harms liquidity, okay? It's all throughout the academic literature. It's the dumbbell effect. So what we have is one-size-fits-all markets in the United States. We put a penny tick size now on every single stock, and it just can't work, okay? So that's why we've been pushing to increase tick sizes to a nickel, actually a dime, and I'll talk a little bit about the academic work we did for the OECD, the Organization of Economic Cooperation and Development. But we did a multiple regression. We ran data on the 26 largest IPO markets in the world, and we found a 70% correlation predicting small IPOs, sub $500 million companies going public. That the thing that drove IPO output was actually aftermarket incentives. If you have higher incentives in the aftermarket, then people take more companies public. And it was dramatically more correlated to small IPO output than any other variable that we ran. We ran GDP growth. Everybody says China is doing well because China has 10% GDP per annum growth. Nonsense. It's got a 10% predictive value. It's GDP growth. So what you find is that government policy at the end of the day is the single most important factor in having robust capital formation. And so just like it's important to improving capital formation, it was the primary reason why we depressed the U.S. economy. We believe that it cost us 10 million jobs in the United States. Okay, there's a delta between what we should be doing in terms of IPOs. We think it's over 900 a year versus the number of corporate IPOs that we've been averaging since the end of 2000 when the dot-com bubble corrected, where we've averaged 135. So that delta there is your jobs problem, and it's quality jobs. So when I talk about how do you make these markets work, the support can be paid for by a couple of places. Either the company can pay for it, or the market structure can pay for it, meaning through that tick size or that spread or whatever you want to call it, the commissions. Then that's really it. It has to get paid for because those markets are not, they don't exist spontaneously for asymmetrical order book markets. And so I think that there's still a lot of companies out there that don't understand that as long as this market structure, public companies exist, that they have to figure out how to make all their dollars work harder for them in terms of lining up aftermarket support with investment banks who are actually going to provide something. A lot of the research I call today is rope-a-dope research. It sits on the shelf. Research doesn't do you any good in terms of creating liquidity if there aren't salesmen and there isn't a way to actively broadcast that research. Okay? And so what happens is, or market makers to take on a position to give them inventory to go make those calls to institutional investors. And so what happens is they get research coverage and they think that they're done. And in point of fact, the research is sitting there, and it's helpful because if an institution has a question, they can pull the research up from online, but it doesn't mean that story is being actively marketed. And so everybody has to kind of really rethink the process that they have of driving liquidity in stocks today. So I want to get back to Reg A, and I think this is kind of fun. How did Reg A get started in Reg A Plus? And this is the whole provenance of the act. And I'm going to talk about where it came from, some of the contributions that we made to Reg A Plus. I'm going to talk about NASA. I think there's a typo there. I think it should be NASAA. Opposition to SEC preemption is misguided in my view. Okay, you're going to find again I'm a plain talker. I think that NASA is doing incredible harm to the U.S. economy, and they need to stand down. Okay, you put on your red, white, and blue epaulets. You want to do what's in the best interest of this great nation of ours. Get out of the way, because the companies that can least afford 2 layers of regulation are the small ones. And fascinating, we'll get into this, is the big companies that do ultimately the most damage to investor confidence when they blow up. So in some respect, Sarbanes-Oxley for large cap companies was probably appropriate. Probably inappropriate in a one-size-fits-all model for small companies, which is why we see that the Jobs Act and Title I actually roll back 404B. So here's the provenance on Reg A. This is how it actually happened. The first draft was, I think it came, for those of you that are of a certain age, there was a great old technology investment bank called Hambrecht & Quist. And it was founded by a guy named Bill Hambrecht. Bill Hambrecht and George Quist. Well, Bill, his old general counsel is a guy named Steve Mochtinger out in the West Coast. And they were brainstorming, because now Bill is running Open IPO, about how do we crash the cost effectively of getting more companies public, because there's clearly a lot more companies that are small than there are large. So we need to kind of liberate them. Well, I think it was probably Steve, being an attorney that knew about Reg A and also knew about the legislative process. I think he once upon a time worked at the SEC. And so they did a markup of the old Reg A draft. And he handed it to Bill. And Bill handed it to Paul Pelosi Jr., who happens to be, from what I understand, Bill Hambrecht's best friend, who happens to be married to the then Speaker of the House, Nancy Pelosi, who then handed it to Barney Frank, who was at the time the chairman of the House Financial Services Committee, who then, and then when the Republicans took control of the House, it was turned over to then Vice-Chairman of the House Subcommittee on Capital Markets, David Schweikert, who was a Republican from Arizona. And so you can see sort of this very Democratic, sort of pedigree, origin, going to a Republican, okay? And this is how bipartisan these bills have been, actually. And then ultimately was rolled into the Jobs Act by the House leadership, Eric Cantor's staff. And Eric Cantor's staff was the one that came up with the name of the act, which was the Jumpstart Our Business Startups Act. For those of you that that want to understand how the act actually got passed, it really had very little to do with the Senate. I mean, because the Senate did not have its own version of the act. So what did they do? I mean, it was the White House. People don't understand how involved the White House was, and in this respect, I take my hat off to the White House, because I don't think they get credit here. But my understanding is that they hired two lobbyists to tell the Senate Democrats that the president wanted a bill. And I know because I was contacted by one of the senior policy advisors to the White House a few days before it was the 10th anniversary of 9/11. I'm the chairman of the board of Tuesday's Children, which is a 9/11 charity, and so I remember that, the 10th anniversary. And I got an email, and he said, you know, it's important. He's with the executive branch. Can you call me? Of course, typical Washingtonian, they don't want to put anything in an email. So I didn't know what it was about. I pulled over on the side of the highway. I called him. He started asking me questions about the IPO market. And I referred him to a couple of attorneys to get some clarification on some things that were rather technical. And then a few days later, the president gave his job speech. And in it, there were 2 lines in it that said that the White House was interested in rolling back the red tape on IPOs. Okay, so then we knew we had hit pay dirt. So when you talk about, you know, contributions to Regulation A+, if you go back and you look, you can get on issueworks.com, and we have a thought leadership section, and you can see some of our testimony. But things that actually, ideas that came from us were actually to have issuers file audited financial statements. We thought that there needed to be some disclosure. One of the things that makes me less confident about private market, secondary markets, is that there's no information standards, right? And so there tends to be the companies that have the bigger brands that everybody wants don't disclose anything, and the ones that are most desperate, that actually need to be marketed, a lot of the biotechnology heavy IP companies, will end up having to disclose more. And so as a former vice chairman of NASDAQ, one of the things that I thought always made a lot of sense to improve markets and market quality was information standards at different levels. Just, you know, it has to be a reasonable amount of disclosure there. And so we thought that was important. We wanted issuers to be required to submit their offering statements to the SEC electronically. And I think, as Mike Zuponi will tell you, you know, one of the fascinating things is you want to go find out how many Reg A offerings have been done historically, and you can't get them on Edgar because there's never been any tagging of Reg A offerings, right? So, and I think the answer was probably, what, 7 a year or something? It was not a big number.
7 or 8 a year.
7 or 8 a year, yeah. So it's been not particularly well used. Periodic disclosure, and then also that the SEC stipulate a so-called bad boy provision in the Act, which is if you're a convicted felon effectively, that you shouldn't be entitled to raise money this way. Some common sense things. So why are small IPOs important? Well, I think, you know, we talked about small IPOs drive down the cost of capital for entrepreneurs, right? It gets that exit ceiling comes down, right? So if you think about it, the venture capital industry, the average exit was going out to 8 years, whereas if you look at it in the early 1990s, from time to investment to exit was about 4 years. Okay? That's a massive change. In fact, I talked to one of my posse, who's a retired partner, still an advisor to NEA, the largest venture capital fund in the country. And I asked, his name is Mark Perry, terrific guy. He's been doing a lot of work around this. And Mark said, I asked Mark, you know, if we got the ceiling down so we could get small IPOs going again, what would it do to the venture capital industry overall? And his view was it would add 5 IRR points, 5% returns across the board to the whole venture capital industry. So that is massive, material, and incredibly, you know, positive, I think, for the U.S. economy. The opportunity cost I mentioned is staggering. We're doing 135 corporate IPOs a year. This is a much better year. We're going to get into that, but the average since 2000, and we should be doing 900 IPOs a year. So this is sort of a very famous slide for those of you that, you know, this is updated, but it was actually taken and one of the early slides that was an earlier version that was presented at the House Subcommittee on Capital Markets in Congress. And what it shows is on 1991 is on the left, and all the way on the right is now 2014. And you see the green tranche is sub $50 million IPOs, and it falls off a cliff what year? And this is one of the things that nobody knew. This was like our big contribution to lighting this brush fire that turned into the Jobs Act. Okay, 1998, it falls apart. Okay, well, Sarbanes-Oxley, which is the boogeyman of, you know, of the business, doesn't happen until 2002. Decimalization, the other boogeyman, doesn't happen until 2001. And so you just gutted the small IPO market, and it never recovered. In fact, if you go back to the 70s, 60s, 80s, you're always going to find that small IPOs dominated the landscape. By the way, the dark line is inflation-adjusted small IPOs. So We started out at $50 million in 91, and the black line is $84 million, adjusted for inflation, just to compare apples to oranges, apple to apples. So what happened in 1998 was Reg ATS, alternative trading systems. We shifted from a telephone quoted quarter point spread market to an electronic order book market, based market. Spreads where went from quarter points, and they collapsed to the minimum tick size, which at the time was a 30-second or 3.125 cents. So you lost the overwhelming majority of your economic incentive as a market maker in 1998. One fell swoop, and it never corrected. And it got worse. And I'm not saying that the rest of this stuff pile on and make it more difficult, Reg NMS, all the competition in markets, but it just was below the point of break even for the vast majority of market makers. And what they did was they reacted rationally. They pulled resources out of the business. They cut research analysts. They moved analysts up market to focus on larger cap stocks. They took all the capital off the desk. Andy is the chairman of Needham. Andy, how much capital do people commit on trading desks today?
Well, I can tell you we have a lot of capital and very little of it is on trading desks. Our average commission is 3.25 cents.
And you've got a high commission. You're doing...
Well, we're worth it.
You. So, what conditions need to be met to bring back small IPOs? The cost has to be contained for companies, right? Can't be cost prohibitive to go public. So Reg A Plus is squarely getting at the cost side of the equation, all right? That's my view. So it's if you will, I call it IPO light. It's sort of in this hybrid land. It's sort of technically an exclusion from registration, but it's not. You're accessing public investors. So it's sort of like IPO light. LITE, and then the aftermarket support model has to improve. And one of the major ways you can do that is to increase the incentives. So I don't want to, you can look at this, you got all this data here. I run through the arguments that NASA is making, in support of its own, point of view. And you can see, I just said it's, laughable. The Commission's December 18 proposal disregards the important role of the states in regulating Reg A offerings. So look, they can still avail themselves of the anti-fraud statutes. Nobody gets a hall pass on that. And so what I like to say is that you can't, if you want to stop all problems in markets and investors losing money, then let's just stop business, okay? If you want to stop all fraud, let's stop all business, okay? But we all know that's not the right answer. And for me, the right answer is getting out of the way, letting these companies, because most entrepreneurs are honest people, letting them do their thing, and then making sure that you buttress up enforcement, okay? If people are doing things that are fraudulent, come on, throw them in jail, okay? But don't keep honest entrepreneurs from raising money, because ultimately this has a profoundly deleterious consequence for the entire economy, not just for quality of life, economic growth, but ultimately national security. This is the stuff that is going to ultimately fund a strong military. This is the stuff that innovatively is going to give us the best armaments. This is the bedrock of our future. And we took what was the best market in the world to birth entire new industries, the biotech industry, the computer industry, the wireless industry, you name it, and we compromised it, okay? And I think that if there is one sin that is unforgivable down in Washington, that is it. We have to fix it. And so every single one of you, if you care about your country and you care about sort of taking back that luster and allowing us to be effectively the leader that we've always been and to provide a better outlook for the next generation, then you got to take some ownership, because it literally it takes a village to get these things changed. And I think that Congressman McHenry was correct about this. This is really not a partisan issue. It's not a Republican issue. Senator Kaufman, who was a Democratic senator, was one of our first supporters. He was Joe Biden's chief of staff for many years. The fact is but what it does take is it takes sort of the everybody in the grassroots getting out and talking to their congressmen, educating their senators, and doing it and winning over their hearts and minds, because the average congressman and the average senator just doesn't have a background in this stuff. So if you don't take the time to do it, it doesn't happen. And so I want to thank everybody that's participated, because I know Michael has, I know Kim has, I think Bruce has. I mean, when I go through this room, a lot of people have taken a lot of time to go down and work Washington, and we need to keep doing that, because that's the only way that we're going to continue to make progress. So so you can go run through some of these arguments. At any rate, I'm ashamed, and I think that NASA should be ashamed of themselves. Okay, just to put a sharp point on it, it's not in the best interest of the country for them to try and assert jurisdiction and get in the SEC's way here. Just isn't. So, we talk about no more one-size-fits-all markets. They harm one group or the other. And look, the right answer was never quarter-point spreads trading Intel. I mean, it was really nice to make those margins once upon a time if you were running a broker-dealer. But it was probably the wrong answer for investors. The best thing to do is just get out of the way and let the order book interact. Okay? But just like quarter-point spreads was the wrong answer for large cap, penny tick size is the wrong answer for the vast majority of small companies. Does anybody know what the median equity market value of a publicly listed company, NASDAQ and New York Stock Exchange is? Median. It's about 500. About 500 million. And about 80% of all listed companies are under 2 billion in market value. And you know what? 2 billion is what institutions call small cap. And 500 million is what institutions tend to call micro cap. Okay? So the vast majority of your stocks need these higher tick sizes, okay? And yet they don't. They've been deprived of it. That's where equity capital formation lives. The really large S&P 500 stocks, they have other alternatives. They can go, because they throw off cash flow typically, they finance with debt, okay? They issue bonds if they need financing, okay? The guys that really need access to equity capital are the small cap, micro cap, nano cap companies. And what we did with this market structure is we hogtied their ability, deprived them of their core ability to attract capital at reasonable prices. So this is the same chart as you saw before, except it's the actual numbers of IPOs. And I want you to look at something really quickly. You see that black line there? That's the number of small IPOs, and on an inflation-adjusted basis. And you can see right now that that's now higher than it's been since 2001, since 2000.
Much of that is the biotech.
Well, that's right. And
much of it is biotech. And that's because the FDA has become much more accommodating. If you track FDA approval in the biotech IPO market, there's huge correlation.
Well, and I would also say, Andy, that when I talk to equity capital markets guys, which I do on occasion, we went from, because of testing the waters, we went from sort of a group of 15 institutions that dominated pricing on IPOs because of testing the waters. It's broadened out to about 45 institutional accounts. And that's made a big difference of de-risking the transactions. That's Title I of the Jobs Act. So that's helped as well. So, but to your point, and this is, here's the data, you can see that in the heavy IP companies, they are the ones, including just technology deals in general, so that they've actually increased as a percentage of total IPOs, which I think is very healthy. And unfortunately, the trend is just we're nowhere near where we need to be, but we're moving in the right direction. So let me see. So we talked about lower tick sizes, increased liquidity for large cap stocks, decreased liquidity for small cap. So by definition, you have to raise tick sizes. That's what the tick size pilot is about. This was an idea, as I said, we floated a long time ago. It was actually, and we wrote subsequently 2 important papers. I think they're important. Actually, one is The Trouble with Small Tick Sizes, which was published by Grant Thornton. And then the other one, which was looking at tick sizes across 26 different markets. I mean, we looked at Australia, we looked at Hong Kong, we looked at Singapore, we looked at Canada, we looked at the United States, and a number of European, London stock market. And the bottom line is that there's a very direct correlation between the tick sizes. Is not absolute, but it's a percentage of share price, which is the right metric. One of the things that people lose sight of is the fact is that some of these foreign markets, the convention allows you to split stocks down to drill bit size to 50 cents a share, a dollar a share. So at a penny, I could have a 1% tick size on a dollar share price. The problem in the United States, though, is that bad things happen under $5 a share. If I'm a public company, the brokerage firms are usually, as a policy matter, can't solicit stocks under $5, and they won't allow you to keep that stock on margin any longer. So most public companies keep their stocks above $5 a share, which deprives them of the ability to use stock splits as a way of increasing their tick size incentive, whereas many foreign countries don't have that problem. And they have a very different convention. And so getting a little technical here. So this is our view. Higher tick sizes is what we've observed. They drive aftermarket sales. They support IPOs in the aftermarket, and they lead to higher IPO outputs. And so this is a very important change, and it's an essential change. And I think that at least they seem to be taking it seriously, although the wheels of progress sometimes grind a little more slowly than I would like. But the first time I walked into Washington and they thought I was crazy was 2007 with a bunch of data. And it was, frankly, it was one of the first guys that paid attention was Senator Ted Kaufman, Democrat from Delaware. But he's a Wharton grad. We took our data we hadn't even published. I think it was a wake-up call for America, which looked at the decline in the number of listings. By the way, we were the first to document that we went from 9,000 publicly listed companies in this country down to 5,000. And we've also, subsequent to that paper, we projected if we hadn't mucked with market structure, we'd be looking at 13,000 listed companies instead of 5,000. And that, my friends, is your job crisis right there. So we talked about, this is just to understand, if the metric is you need to get at least 1% economic incentive into a share in a tick size, a penny on $5 is 0.20%. It's not even remotely close. I mean, so if I look at a 5 cent or a nickel tick, which is what the SEC pilot is looking at right now, you have to be all the way down at $5 to get to 1%. So, you need 10 cents on $10. This is why I'm so happy that the House has been trying to push at least a test on 10-cent tick sizes, because I think it's going to be needed to kind of, push, to get a good data set out of the pilot. And right now, the pilot is currently written is only looking at nickel tick sizes, but it's still a step in the right direction. Other criticisms of the tick size pilot: a year is way too short. If I'm going to test 3 different buckets of stocks and I'm in the market maker, unless I'm required to stay in the market and adjust my technology, I'm apt to make the decision that it's not worth recoding my systems if it's only going to last for a year. 3 years, it probably works. 5 years, it definitely works, because I'm not going to miss out on that kind of an opportunity. So we've been really pushing the SEC right from the beginning, saying that it should be a much longer pilot. And we still think we're right.
What are the economists on the staff think?
Well, I don't know the answer to that. I mean, the real micro markets economist who's a commissioner is Mike Pilar, right? And I don't know the answer to that. I do know, like, if you look at Gallagher as commissioner and you read his speeches, he's calling for something we called a number of years ago for, which is he calls it a venture market. We think that you need a whole different. It would be nice to have a whole different rule book where everybody from if you will, enforcement to trading and markets to corporate finance were horizontally integrated with the banks. Everybody that was interested in the small cap ecosystem, institutional investors, had a seat at the table, because we'd come up with very different answers on market structure than we currently have. And we have a remarkably large cap bias. And when you look at the SEC structure, the only area that has a small company discipline is the Division of Corporation Finance, right? There's no analog to that over in trading and markets. And trading and markets makes these changes that then affect the fortunes of issuers and capital formation. And they really need to have somebody there minding the store that really understands that small cap stocks are different from large cap stocks, in my view. Yeah.
What will prove the tick size model? What would be, beyond the shadow of a doubt, what would prove?
Well, if people got in and started fostering liquidity and institutional ownership, and some of these stocks started to increase, and block trade started to go up, and there's a lot of metrics that would look at that would effectively indicate that there were improvements in these quality of markets.
Would brokers start adopting the model?
Yeah, well, I mean, I think that the brokers, if it was long enough, they would all get in, and then the question is, what would they do when they get there? Look, if the liquidity increases, and I hear this from long-only institutions, Andy Brooks at T. Rowe runs equity trading, has been active, and I'm trying to think of the guy, senior moment right now, the guy that runs equity trading at Invesco has been active, and a terrific guy, I can't think of his name right now, but if you're liquidity constrained, right, what do you do as an institution? You move up market, right? So what you've seen is a tactical reallocation of assets on the institutional side away from smaller capitalization stocks, okay? And if you want to see valuations improve for smaller cap issuers, you can improve liquidity, which means that now a T. Rowe Price can get, or a Fidelity can get into a smaller capitalization stock and not have to worry about being able to trade out of it. And so what we think that this will do is ultimately will cause a reallocation of, there's about $20 trillion in liquid equity assets in the United States. Some portion, it doesn't take much, reallocated to small cap stocks, will increase prices, drive down cost of capital, and it will improve then the throughput of the equity new issues market, which will then take down the numbers of years that it takes for a venture capital investment to bear fruit. There'll be more money than accessible to private markets, so all your crowdfunding businesses will start to look better too. Okay? It creates that virtuous circle. And if you think about what happened going back, 15, 20 years ago, back to Reg ATS in 1998, we created a vicious circle. We took the incentives out, liquidity dissipated, people pulled money out, started to shut down. And by the way, if you look at the Brookings Institute studies and the SBA numbers on small company startups, the rate of startups in this country has gone through a secular decline over that same period of time. And you could argue about whether or not that's cause and effect. I think it's cause and effect. Ultimately, it goes. We did a piece at the University of California at Berkeley at the Haas Business School, and we likened equity markets to supply chains. And you start out with angel investors, mom and pops, and you go A rounds, B rounds, C rounds, D rounds. Then you get to a juncture where you have to decide what the exit is. You can unwind the business and shut it down. You can do an M&A exclusive sale, or you can do an IPO. But if you look at the distribution in the public markets, what happened when we went to penny tick sizes and lower commissions, and by the way, the self-directed retail model played a role in this too. We took $250 round lot commissions, and we blew it down to $5. So now everything's self-directed. There's no longer a retail marketing model. And what you started to see was Wall Street got out of the retail brokerage business. 100,000 retail brokers that used to smile and dial for a living, as we like to say, no longer smile, and they no longer dial. They're out there on the road trying to get your assets and allocate it to alternative investments, hedge funds. They're still getting paid, by the way. They're making as much money as they ever did, but they're now no longer doing a service for the U.S. economy, in my view, and by supporting liquidity and the competition of ideas and discussion of entrepreneurship. Now they're talking about the great new fund that they can put you into. And Bruce runs a brokerage firm, so I hope you don't disagree with that. I think he does some traditional, he's one of probably the few that still does some traditional brokerage. And then on the institutional side, I mean, literally almost every investment bank got out of the middle market institutional sales business. They got rid of the desks. And then you go to a place like Morgan Stanley, and the coverage model is they got 200 accounts per salesman on the middle market institution, the ones that still have it. Nobody's making outbound phone calls, okay? So that was our sales and marketing support. When I talk about things in the tick size pile, remember, you have to get models. Markets can compete on one of two things. They compete on price, and if you cause them to compete on price, then they tend to devolve, and everybody competes on price. So if you give somebody a nickel tick and you allow them to do rebates or price within the tick, price improvement, very quickly all that order flow is going to try and chase the rebate, right? So I think that one of the things they need to do is they have to respect the tick. to paraphrase the defense for O.J. Simpson. You know, you must acquit. If it does not fit, you must acquit. Well, you have to respect the tick. And if you respect the tick, okay, then all of a sudden people will be competing, or the sell side will be competing on the basis of value creation, value provision. What is value provision? It's access to the balance sheet, it's capital, it's sales support, marketing support, and it is equity research, right? That's the value chain. So, final comment. I think that Reg A offerings may not be the best, should crowd finance Reg A offerings not necessarily the best approach. I mean, we talk about that. I think that what really, there was a lot of discussion in the last panel. We're advocates of you got to find the right idea for the right investor, and you're still going to have to get out on the phone and sell them. So just thinking that you're going to set up and they're going to come to you is not the way that we're going to close deals, in my view. And particularly for the heavy IP companies, the more complicated the story is. Somebody made, I think it was Gene made the point, right? I mean, if something's really popular and you got Neil Young is out there, hawking something, $6 million comes in, boom, you're done. But most companies that are raising capital don't have Neil Young, and particularly the kind of the really brainy engineering things that are going to find the cure to cancer, that are going to solve global warming, that are going to find renewable energy. They're all those are going to be things that need to be sold, because they require people to really kind of kick the tires, get into the story, and have a level of commitment. And the interesting thing about crowdfunding is crowdfunding's not concerned about aftermarket support. And if stocks trade down and they aren't supported, then people don't want to buy the next one. Nothing like deals trading up and people making money to keep the pump primed. I mentioned we hope that NASA and Congress will see the need to preempt higher cost state regulation of larger Reg A plus offerings. That's everything over $5 million, because we think that will really make Reg A plus attractive to the market. And we hope that Congress and the SEC will improve aftermarket incentives to support small cap stocks. And I think these things are going to happen. I really do. But they're not going to happen if you don't keep the pressure up and keep the conversation up. Hey, Richie. Any questions?
Just one question, because I used to be an auditor at Deloitte, but I just want to make sure I understand. You're saying higher tick sizes would incentivize the market for the market makers, and then as a result of them starting to sell these small cap IPO stocks, you're saying it'll be better for everyone involved because now people will be pushing these smaller stocks. Is that the basic premise? If you increase the tick size, it means more money for the market maker. That means that they'll be pushing more towards the small.
Well, Andy Mount, by the way, is chairman of Needham and Company, and you said that they're getting 3.5 cents commissions. Well, if you put a nickel tick in there on these smaller stocks, and the larger ones will still have a penny, then all of a sudden maybe you can make as much as a nickel, and you tack on a commission, you can make some.
Actually, that thesis is 100% right. We do not have incentive to cover stocks and research because we can't recoup the cost of it in trading, not at 3.25 cents. And that precinct, these are typically stocks that don't have large trading volumes. Even if my firm got 25 or 50% of the daily volume, that still would be 3.25 cents, which was 3.5. It does not make economic sense. So,
What would work?
Nickel does it.
Andy, what would work? What point would work?
I think a dime works.
A dime?
Yeah, and that's why the Duffy bill has a dime in it. I think they got to try them.
Yeah, I think a dime works at least.
It's almost as if you're making the market inefficient in a sense, because you would think a more precise tick size would be, it's making the market a little bit more efficient.
I would argue we're making the market more efficient because liquidity increases, as I said, with higher tick sizes in smaller cap stocks. I would be making the market less efficient if I was going large cap and increasing tick sizes, but that's not something that we've called for.
We would put more money on the trading desk, and in fact, there would be more liquidity in thinly traded stocks by firms such as we, risking our capital, because at a dime spread, we can probably make it back, and we're willing to make the risk. At 3 1/4 or pennies, a penny spread, we're not going to do it.
And to your efficiency, question, and which is a really good one. Large cap stocks are innately visible. Okay, that visibility creates efficiency, right? People are buying and selling these stocks. Little stocks, somebody needs to tell a story. They're inherently unseen. So how are they going to get shown? How are they going to get seen? And it's because people like investment banks are going to provide research. They're going to get salesmen on the phone. They're going to position a block of stock, and they're going to say, okay, I have an opportunity to put you in, because they can elect, for instance, if the stock's trading at $10.10, and they bought it at $10, they can elect to control their risk and just put it out at 10 with a commission of 3.5 cents. But they can manage their risk a little bit better. But maybe if it's an attractive opportunity and you got people that really want into it, he can mark it up and put it out at 10 and a nickel or 10 and a dime or something, and make a little bit more spread. But what that's going to do, look, I ran banking, research, sales, trading strategy at Prudential Securities. I cut all these jobs when they changed these market structures, okay? So I know the cause and effect, firsthand. And so I also know that if you put a carrot out there, people will invest in these businesses. We used to look at small IPOs economically, and if I ran the books on a deal, this was back in the 90s, okay, I would triple my profits in the aftermarket on the basis of controlling the books. That was kind of the rule of thumb. So, looking at it a different way, I could afford to book run a $10 million IPO that in today's terms would be like a $40 million IPO, okay, in terms of equal economics. So when people look at why are there so few small IPOs, the reason is, to paraphrase James Carville, it's the economics, stupid.
There's another subtlety here where the large institutions talk about transaction costs, and that's why they want to trade flat, virtually no commission. Whereas the smaller institutions that are interested in smaller cap, their mandate is to buy and hold emerging growth companies, right? And when they go in, they really pay much larger transaction costs because there is no liquidity, because the brokers are not incented to make deep markets. So when your trade where the stock is $10 to 10 cents, $10 bid, 10 cents offered, if an institution came into me and said, I want to buy 50,000 or 100,000 shares, I'm going to offer it at 11. Because that's the only way I can control my risk. But well, that's 10 to 10 cents. If it's 10 to a penny, all right, I'm going to offer it much higher. Or if they came in, on the other side to sell it, I'm going to bid way down because there's no liquidity. There's no liquidity. I think it's a dime at least to really make a difference. Nickel is a step in the right direction, but it's a dime for it really to matter.
Yeah.
What role do you see high frequency trading playing in any of this?
I think high frequency trading is a symptom of the underlying disease. I don't think that it's so much a big problem. I mean, they're picking people's pockets. They're not adding liquidity. I think that's one of the great lies. I mean, somebody holds on to a stock for half a second and they go out flat every single night. That's not liquidity. Liquidity, my definition of liquidity is when you go out and you find that you create a buyer where none previously existed to offset a seller, or you create a seller, you find a seller when somebody's looking to buy. And trading per se does not do that. Trading facilitates order creation and market making, but trading and just connecting pre-existing order flow together is not, at the end of the day, it's important, but it isn't what makes markets work. What makes markets work?
6 milliseconds.
6 milliseconds, is that where it's down to? Yeah.
There's a question about the other side of the equation, which is driving out issuer costs to incent them to adopt a Reg A offering or a small cap IPO. And that one component of that is around the disclosure.
Right.
How do you see, I guess, underwriters being concerned about liability and then wanting to bring the disclosure up to effectively, traditional IPO levels? How do you keep a light disclosure regime?
Well, I mean, if you go back and you look at when Microsoft went public and when Intel went public, the prospectus was about that big, and
50 pages.
Yeah, 50 pages, and it wasn't like, I mean, how much is there to say about it? That's really material about a small company. I mean, now we got everything in the footnote. I would argue that it absolutely destroys retail investors, because the only person that's going to read that much in the way of a disclosure statement, that was like the size of that when I printed it out of the Facebook, is an institution that Alibaba that has an army of people to wade through these things and look at the footnotes. It's not doing anything for the public good. I mean, maybe somebody could write about it, but at the end of the day, if that was good enough for Intel and Microsoft, I think it's good enough for the vast majority of companies. So I just don't. I think it's like the old is perfect is the enemy of the good, of the very good, right? And in order to get perfect in terms of disclosure, that last couple of percent is just absolutely crushing and adding, I think, very little marginal value to the market. That's my personal feeling, my personal opinion.
So I suspect that there's like an underwriter liability issue that's driving a lot of that, and they're looking to offload that with disclosure. And the way I understand A+ is that the liability components won't change. So I'm wondering if it's kind of shooting itself in the foot by then, if you have underwriters driving the process, are they still going to keep up costs by saying we need to disclose the hell out of this because we don't want any risks on our end?
And I think one of the attorneys would be better positioned to answer that question. I think that what happens with these things is you get them out there and you see how they work. I mean, I was like Marty Dunn, who was the former head of the Division of Corporation Finance at the SEC, was saying, one of the great surprises of his experience at the SEC was that they changed the rule, and it's sort of like the corporate securities bar is a little bit like penguins at the edge of an ice floe. They're waiting to see how it's going to be adopted. They don't want to make a mistake. And so you can look at a rule that's been passed at the SEC, and for a year, hardly anybody adopts it. It takes a while for people to get comfortable. Doesn't mean that it won't ultimately. I mean, I had that experience with Linda Quinn years ago, and like all these transactions that are done today that are wall crossing transactions and done off of Form S-3 shelf registrations, I did the first ones. And the reason I did it, and the rules had been out there literally for a year, and I kept looking at them saying, why can't I just do an overnight deal for a non-investment grade issuer? Why is nobody doing this? And I went in to see Linda, who at the time, she's since passed away tragically of breast cancer, but she was at Sherman and Sterling. And I said, Linda, why has nobody done this? And she said, we can't understand it either, because that's why we passed the rule. And so to your point, I think that they're going to have to monitor it, and if people aren't using it, they'll have to come back at it. And it may even take another bill in Congress. But I'm going to tell you, nothing good comes easy. And I've got literally 7 years, I think, invested of my life in this thing right now. The first time I showed up in Kaufman's office was, I think, 2007. I mean, I was Senator Crapo, and told me that my data was too complicated. It was the greatest advice I ever got. I had to put one idea per slide and simplify things for the Hill. But we've come a long way, and it's getting better, and you're seeing that there's been some improvement. And if we hadn't started doing this in 2007, there wouldn't be talk about crowdfunding of equities under to accredited investors, Title II, right?
I mean, your work inspired an industry.
Right.
It's moving. It's moving. And look, I want to say we're in the, I look at it like we're in the third inning of a 9-inning game. And I mean, literally every single, and I don't care, some of you guys you remember it, are a little bit older, but it's about the legacy that we're leaving our kids. I mean, our ancestors, took covered wagons to the, and had no hospitals, were dying of disease, they were fighting Indians, and now all of a sudden we're worried about a little bit of disclosure on some level, or people having a sales practice abuse because there's a little bit of economic incentive to make markets work. I mean,
Well, I was actually on both the Intel and the Alibaba IPOs. The Intel prospectus is 38 pages. The Alibaba prospectus is 300 pages.
Wow.
so, and just so you know, in case you're guessing how old Andy is, Intel was 1971 when it went public.
And how big was the IPO?
$8 million.
7.25.
7.25.
$35 million post-money valuation.
And it missed delivery of its first product out of the box.
Oh, yeah.
Stock got cut in half.
Oh, no. We came to 21, it went to 9.
Did it?
Yeah.
And the company was only 3 years old when it went public too.
And, well, it's 3.5.
3.5.
It had to be in those days, it had to be 3.
He's nitpicking.
And it was one of the 11 companies that at one point in time had a market cap of over $500 billion.
Well, I think more
1998.
importantly about Intel, I mean, if you look at what they did to drive the semiconductor industry and what it did to things like the computer industry and wireless and genomics, I mean, you don't know what the ripple effects of these companies are going to be when they're sort of game-changing technologies. None of us have a crystal ball, and so my view is we want to get more of these balls up in the air because none of us are smart enough to predict which ones are going to, ultimately save mankind.
And even the failures, I mean, because there's someone, a success, arrives from one of the failures. They learn from those mistakes and then they, build something and make it better, so.
I'm gonna hang around. I'm standing
Yeah.
between people and alcohol.
Yeah,
That's never a good thing.
Thank you. That was good. Yeah, thank you all so much for coming. We're gonna have some drinks. We'd like to thank our sponsors, our speakers, and everyone for coming. This was really great.